Hey guys, my name is Mike Boyd, this is The Money Flare, and today's video I want to do a quick follow-up on a video that I made roughly 2 weeks ago where I described how we seem to be entering a period of weakness in the market. And I showed a few indicators that to me were showing warning signs that we could see a potential correction to come. Just to go over what some of those warning signs were, we had price looking like it was getting pretty overbought and overextended. We had decelerating volume, pretty low volatility, and low put-call ratio. We also had some signs of extreme market sentiment and market positioning. And we had things like the copper-gold ratio looking like it was sort of peaking and rolling over. We had utilities and consumer staples that were outperforming, so the more defensive parts of the market that were outperforming. And all this while keeping in mind that April and May tend to historically be not the best months for stocks because it's usually a time when people are selling for tax reasons. So things were looking like it was time to get a bit more defensive. As I mentioned in previous videos, with the current market structure of such low liquidity and the sheer size of the passive component, markets are a bit more fragile now, and any corrections that happen tend to be pretty quick and pretty violent. And so there's no harm in being a bit more defensive sometimes, especially when the market's sending signals like I described. So those were some of the signs that I was seeing, and I was calling for potential market correction, and I was preparing my own portfolio for a potential correction. But a correction can happen in time or in price. So either we can get price coming down or we can get price moving sideways and the correction just happens slowly over time. And what we've had was a correction in time. And over the past 2 weeks, while some of these warning signs still remain, a lot of those indicators have started to reverse. And the key takeaway here, and the main reason why I wanted to make this video, was to let anyone watching know that, in my opinion, the market is showing all the signs that it wants to continue going higher. And I've always wanted to be completely transparent with this channel. So I'm happy to report that I've rebought all the stocks that I sold. I've closed all my bearish positions, so all my negative bets on the market. And I fully expect the market to go higher from here. So let's get into why I changed course. I released my video on April 14th, so it's right around here. And it was maybe a day or two later when we started to see the market get a lot more choppy. So volatility increased. So around April 14th, right here. So volatility increased somewhat, but it didn't stay elevated. We saw it come down afterwards. And so the longer that this sort of sideways price action went on, the more that we saw the market have very solid support here, the more I started to really reevaluate my thesis that we might see a correction. And as you can see, the market basically for 2 weeks went completely sideways. It didn't go up, nor did it go down. The fact that the market only went sideways in this time period, given all the warning signs that I mentioned, is pretty telling in my opinion. So the market only dropped maybe like 1.7, 1.6%, which is nothing. And this to me tells me that the inflows coming into the market are very, very strong, and the market has really, really strong support. And not only that, I mentioned before that some of those other indicators I was tracking were also showing signs of reversing, and the dollar was one of them. So prior to that video, the dollar was looking like it was starting an upward trend, but soon after it reversed, and now it's looking like it wants to continue the longer term downward trend since March 2020. And we see the same thing for utilities and consumer staples. So those are more defensive sectors in the market. And as I mentioned in that previous video, they looked like they were outperforming. So it looked like the market was getting a bit more defensive. But soon after, they quickly reversed. So here, utilities reversed, looking like it wants to continue this longer term downward trend. And same thing for consumer staples. They also reversed, looking like it also wants to, continue that downward trend. So those short-term spikes were simply head fakes. And most telling of all is the copper-gold ratio. That looked like it was rolling over, but it quickly shot up to the upside. And I like to focus on copper because it really tells you where we are in the current cycle. So along with the yield curve, it's one of the best leading indicators because copper is used as a material in so many industries. And while some of the price increase that we've been seeing lately is due to supply chain issues, a lot of it is due to increased demand. So this key indicator started going to the upside, and so it also reversed. So overall, the past 2 weeks have been sending a pretty strong signal here that this is not the time to be betting against the market. And as I always say, you can't be dogmatic in your views. So I thought we might see a correction in price. So I thought we might see maybe a 10% correction like we had back in September and October 2020. But that's not what we had. We had a correction in time. And so I'm going to now pivot. The market's telling me that I'm wrong, and so I'm pivoting. I'm changing my opinion. And right now the market looks to be primed to go even higher. In general, you want to be bearish or negative on the market only for a short period of time, because the natural direction of the market tends to be higher. So people work and they make money and they invest in the market, and all those inflows going into the market don't reverse until we start to see the end of the economic cycle. So when we see growth and inflation slowing down, and when we see the yield curve invert, and all these things create a period of vulnerability in the market where any catalyst like COVID could then set off a major liquidity event and set off a market crash, right? So, but in the grand scheme of things, these spikes in volatility and these market crashes don't happen that frequently. So when you look at the overall chart, they happen very, very infrequently. And so that's why you don't want to be really taking on that bet for too long, because it's not a really high probability event. But that doesn't mean that you should just blindly invest in the market either, because we've seen many times in history where for 20 years the market went sideways, like we saw in the 1940s and the 1960s and also in the late 90s. But given such a strong upward trend like what we have now, you shouldn't make very long bearish negative bets. You shouldn't really hold that view for too long, because there's no point betting against the market forever. And let me reiterate where I think we are in the current cycle. I mentioned it in a previous video, but I'll say it again. We seem to be into an economic recovery. So we're seeing GDP growth and inflation rising. And that's very positive for cyclical stocks. So it's good for stocks that do well when economies are doing well, like industrials and airlines and materials and commodities and energy and banks and all those things. Let's look at inflation. And whether or not we have persistent long-term inflation is a topic for another video, but the current data is very, very clear. So companies over the past month or so have been reporting earnings, and the number of times that they've mentioned the word inflation during those earnings calls has risen substantially. So here's a chart, and in dark blue is the number of times that companies have mentioned inflation in their earnings. And it's up like crazy. And usually this tends to lead inflation. So in light blue here is CPI inflation. And so this tends to lead the CPI inflation. So this is a sign that we might see increased inflation or further increases in inflation going forward. And as I said, a lot of this is due to supply chain issues and some excess manufacturing capacity. So we're seeing some major backlogs in new orders. Here's the Philadelphia Fed manufacturing unfilled orders chart. Same thing with the Empire manufacturing unfilled orders. It's going up a lot, so we're getting a lot of backlogs. And all of this combined with a surge in demand as economies are reopening is creating an absolute surge in manufacturing prices. And we're seeing this in the manufacturing surveys. So outlook for prices of received finished goods is up higher than it's been in a long, long time. And this, once again, tends to lead inflation. So in red, we have CPI inflation. And so usually when you have the price of finished goods increasing, you usually have inflation going up as well. And all of this as well is leading to a major spike in commodity prices. So here are just a few. We have plastic prices going up like higher than they've been in such a long time. As I mentioned many times before, we have copper prices going through the roof. We have corn up. We have soybeans up. And my favorite is lumber. Look at the price of lumber. Maybe I should make it blue so you can see it better. Look at that. We haven't seen these prices as far back as we have data. So as far back as 1973, we haven't seen the price of lumber go so high. This is due to a lot of factors, housing and all that stuff. And once again, some pretty constrained supply chains. But still, look at the price of lumber. Overall, the price growth of industrial commodities is showing no sign of slowing down. And this level of commodity price moves is something we haven't seen in over 50 years, since the early 70s. And it's not just commodities, we're also potentially going to see some wage inflation. So that same manufacturing survey found that the outlook for wages and benefits is absolutely surging. And not only that, a lot of companies in the US are reporting that it's never been harder to fill positions. So we're seeing a lot of unfilled positions recently. And usually, as you can see in this chart, so here the unfilled positions is in dark blue, usually that leads wages. So wages is in light blue. Usually when you have more demand or sort of more of a competitive environment, competitive job environment, job market, we see wages and compensation going up. And so we might have some wage inflation going forward. And so with such strong signs of inflation increasing and GDP growth increasing, this is just more evidence that we are really at the beginning of the next economic cycle. Even with stocks at all-time highs, we're at the beginning of the cycle. And with valuations at all-time highs and with such extreme positioning and sentiment, this is not the time to be out of the market. Many people like to point out how elevated stocks are and how much risks there are out there and how much speculation is going on. So for example, here's the S&P 500 index compared to the total margin debt. So look at all the margin out there. So all these things, all these risks in the market, how valuations are so high. So here's an example as well, how valuations now, according to this chart, are pretty elevated compared to the long-term trend. But what you also have to keep in mind is that things can get even more extreme before we eventually see a correction or a pause in prices. So stocks right now may be overvalued, but look here, back in the 90s, the late 90s, stocks were overvalued for like 3 or 4 years before we eventually saw some type of eventually we saw a crash, the internet crash. But it was overvalued for 3 to 4 years. So the key takeaway here is that valuations are never a catalyst. And so don't expect a crash tomorrow because valuations are high. Other factors are what drive prices. One indicator that I like to follow is the CNN Fear and Greed Index. And unlike other sentiment indicators, this one is more of a market-based indicator. So while I showed in my previous video how there were certain surveys that showed people were very, very positive on the market and maybe a bit complacent, this one takes into account more market prices. And right now it's sitting at a 62. So we're in the greed phase, but we've been much higher in the past. So if you just look at the past 2 years, we've been higher before. We've been much, much higher. Right now we're in the 60s, but we've been all the way up in the 90s, getting close to 100, right? So things can get much more extreme. So don't listen to all the negative articles talking to you about the worrying signs in the market or the articles that tell you to be cautious even though everyone else is bullish. You don't usually see these kind of news articles at market tops. So keep in mind the steepening yield curve and all the massive inflation data and the recovery data that we've been seeing over the past few months. Why wouldn't anyone expect such a massively overvalued market bubble in response to all that? I've held the belief ever since late last year that this current market rally that we've been seeing has been really, really hated by investors. They've had, I think, at least it seems that they've had one foot in the door, so they've had some exposure to stocks, but they're looking for any opportunity to sell because people they don't want to believe how quickly stocks have recovered. And I have some of those feelings as well myself that I have to sort of fight back on. So for all those reasons, I'm back to being fully invested. I'm going to keep riding this wave as we climb this wall of worry, and we'll see how things go. And so until further notice, I'm back in the market. I hope you guys enjoyed the video, and I hope you were able to get an idea of where I think we are in the current cycle and where I think the market's going to go going forward. And as I say all the time, you have to listen to the market and you have to pivot when the market proves you wrong. And I hope I was able to demonstrate that to you guys today, where I had a short-term negative opinion on the market, but I was proven wrong, and now I'm pivoting. And so now I'm back in the market, I'm fully invested, and I expect it to go higher. I think the momentum is definitely up. And so we'll see how things go. I'm going to keep all these warning signs and these indicators that I mentioned, I'll keep them at the back of my mind, but I'm going to be, for the time being, fully invested in the market. Once again, I have to reiterate that I'm not a financial advisor and none of this should be taken as financial advice. I'm just presenting my views and my opinions, which are hopefully valuable to anyone watching. And with that being said, I'll also be making my top stocks video for May coming up soon. So please stay tuned for that. And once again, as always, thank you guys for watching. Be sure to like and subscribe, and I'll see you at the next video.